Hello. So the topic that we're going to start is financial decision, that is capital structure. So we have seen a lot of financial decision till now, investment decision, dividend decision and all. So one such decision is financial decision. So what does financial decision involves is your basic questions with respect to investment, like what should I invest in, or what should I buy, or where should I invest, where should I park my money, and for how much duration it should be there, and what proportion it should be there. So all the questions like this will be answered in the capital structure. Okay, so to begin with, I have got my own notes, so we'll see this. After completing this, you can have a glance of ICA material. So first of all, capital structure. Capital structure is the combination. What is it? It is the combination of capital from different sources of fund. So what are the different sources of fund we know till now? Equity share capital, preference share capital, debt, and also retained earnings, right? So these are the sources of fund through which an entity can raise its capital. So this is called capital structure. So what is a capital structure? A capital structure is like a box which contains elements of capital, that is equity, preference, retained earning. So whatever possible combination or whatever composition of capital is being kept in that structure is called the capital structure. Okay, then it refers to the deciding the form of financing, that is which source of fund to be tapped. So from where should I get the sources of fund to be generated? It could be from equity, it could be from long-term debt, it could be from preference share capital. Then their actual amount. So from where am I getting the fund, and what is the requirement? What is the exact amount of fund that I'm expecting to raise from the particular source of fund? Then their relative proportion, that is the mix. So let us say if the company wants to raise 1 lakh rupees and there is a debt equity mix of 1:2. So what would be the allocation? It would be 1 part of equity and 2 parts of debt. So that would be the case for proportion. So proportion basically means a mix or different kinds of capital that is being used for raising the fund. So if we take 3 sources, it could be equity share capital, preference share capital, and retained earnings, or whatever the case may be. So this is called the structure of capital, or the combination of fund that is being used and the proportion in which they are used and from where they are being raised. So all these questions are answered in the capital structure decision. Now, the sources and quantum of capital is decided by keeping in mind the following aspect. What are the aspects? Firstly, we know that FM has 3 major decisions that should be taken by each and every person. So first, investment decision. How much fund is required? What is the amount of fund that I need for the particular project or investment or production of goods or services? Okay. Then from where should I get it? So if I am going to get it from debt, where should be the source of debt? Is it a bank loan? Is it a debenture? Is it a bond? So what is the source of debt from where I am going to raise the fund? So this is the first basic question. Decision. Now, what are the chapters that cover these decisions? Chapter number 2, 4, 5 and 6. Okay. Now, next comes investment decision. Where to invest? What is the amount of investment that I should make? Is it a fixed asset? Is it a current asset? So what the investment should be? So this is dealt in chapter number 7 and 9. Then dividend decision. So after doing all these things, I'll get something called profit, right? So this profit can be divided as divisible profit and operating profit. So from operating profit, what we'll be doing, we'll be reducing the interest part, and then we'll be reducing the taxation part, and then finally we'll be having earnings available to owners, and from that we'll be reducing preference dividend, and after that we'll be having earnings available to equity shareholders, right? So that would be divided into number of shares of equity shareholders to get the earnings per share, or the amount of dividend that they are going to get for individual shares. So all these things can be answered from dividend decision. So dividend decision basically deals with how much profit to be distributed among the equity shares and how much to be retained in the business. So this is covered in chapter number 8. Okay. So how is this related to capital structure? So the source and quantum of capital is decided by keeping in mind the following aspect. What are they? Control, risk and cost. Why is control important? Because control is important because capital structure should be such a way that maximum existing shareholders contribution have majority stake. Okay, so why is it so? Because the more we have from the existing stakeholders, our control is not diluted. So you just imagine if there are let us say 5 shareholders in a company. I know it's very less. So there's 5 shareholders in a company. Now they have to take a decision. How will it be taken? They'll have to ask all the 5 members, and a resolution or a board meeting should be passed. Only then the decisions of the company is inculcated, right? Now just imagine a scenario where these 5 shares are split and they are issued to, let us say, 1 lakh equity 1 lakh shareholders. Now 1 lakh shareholders are there in the company. So in order to answer a particular question, that is to pass a particular resolution or to take a particular decision, we'll have to consult all the people. That is we depend on the votings that they are going to give on passing the resolution or not. So till now we had some control. Okay, 5 members are there, we can have better control. Now you just imagine having 1 lakh shareholders who are to vote. You might not be very sure how many person are going to vote for and how many person are going to vote against, right? So what happened here is dilution of control. This is called dilution of control. So that's why control, when it comes to control, capital structure should be such way that the maximum existing shareholder capital continues to have the majority stake. So new part can be minor. Next, risk. Financial risk should not increase beyond the tolerable level. Why is it so? Because once it exceeds the tolerable level, I start incurring operating losses, non-operating losses and all kind of losses. Why? Because I have certain amount of fund invested, and from that I am getting certain amount of profit, and only with this profit I am going to meet all the expenses, that is operating in nature, non-operating in nature, or whatever the case may be, right? So what is the risk that I am going to bear? If I am going to invest entirely in equity shares, now just imagine equity shares is owner's fund, right? So I get return on equity share as profit or dividend. Now imagine a situation where there is no profit in the entity. Will I get any profit? Will I get any share of dividend? No, I won't get anything. So how will I think as an investor? Okay, I have certain amount, let us say I have 1 lakh rupees in my hand. So I'll invest 50% in equity and 50% in debt. Now what happens? Even if I don't get profit, I will definitely get an interest for the debt which I'm going to give to the company, right? So this is how I am going to leverage. What is leverage? This is how I'm going to balance my financial conditions. I'm going to set off my fund such a way that it gives me lesser risk, or it can balance the risk that I'm going to take on another investment. Okay, next comes cost. Overall cost of capital remains minimum. Okay, so cost of capital should be minimum. So that's the basic idea. Whatever be the cost, always we'll be focusing on reducing the cost, right? So we should focus on overall cost of capital to be minimum. So all these things to be kept in mind before making any kind of investment or raising any fund. So practically it is difficult to achieve all these goals, all these 3 goals. Hence a financial manager, that is the FM, should try to have a balance with this. So there should be some kind of balance. It should be tolerable, there must be some control, and the cost should be reasonably less. All these conditions should be met in order to have a better investment. Okay, then so what is the objective of financial manager of a company? First one, maximizing the wealth, that is value. Okay, then maximizing the value of the firm. Thus it is also prime objective of deciding the capital structure. So what is the value of the firm? Is it increasing? Is it decreasing? Is the majority part of value shared by share capital? Is it from debt? So all these things matter before taking a prime capital structure decision. Okay, now how will you find the value of firm? So in a firm, whatever be the sources of fund, If we sum up all those things, we'll get the value of firm. So simply put, let us assume there is only two kind of fund available in a company. One is debt and another one is equity. Okay, so what are the two sources? Debt and equity, right? So only addition of debt and equity will give you the value of firm. So how will I calculate the value of equity? How will I calculate the value of equity? So what is the return for shareholders, equity shareholders, earnings available to equity shareholders, right? Or this is the net income. So in this entire chapter, I would like to give a note that in this entire chapter, wherever we are denoting something called net operating income or net income, we directly relate to EBIT or earnings available to equity shareholders respectively. Okay, wherever it is applicable, it keeps applying. Okay, then cost of equity. Cost of equity is nothing but KE, which we studied in the previous chapter, that is cost of capital. So we have a lot of method: dividend decision method, price yield method. So all these methods can be used to calculate the KE, and with the help of that, when we divide the net income, we get the value of equity. Now the same is applicable to that. What is the source of income that I'm going to get from debt? Interest, obviously, right? When I give someone a loan, I'm going to get the principal plus interest. So this interest part is called income. This principal is nothing but a recovery of the amount that is given. So how will I calculate value of debt? Whatever the income that I'm going to get from debt divided by KD, that is cost of debt. Okay, so in this chapter we study capital structure theories, where we assume that maximum firm has only two sources of fund. We are going to assume that all the firms that we are going to deal is having only two sources of fund. One is equity and another one is debt. Okay, so how are we going to calculate? Because there is two sources of fund, both are entirely different. So how am I going to analyze it? How am I going to compare each and every source of fund? Because equity will have its own classification of fund, and debt will have its own class. Like it would be sometimes 16% debt, it would be 18% debt. So how am I going to maintain the equality and make a decision? Because in order to take a decision, I should have an equal base, or something that is comparable. So if we're going to take it as it is, it's not comparable, right? So that's why weighted average comes into picture. We are going to make it uniform and to have weight to each and every class of fund, every capital type, that is the cost of equity or cost of debt or retained earning or preference share, whatever the case may be. We're going to add some weight to it, and based on that we're going to sum up everything, and based on the weighted average cost of capital, we're going to take all the necessary capital structure decision that is required for the company. Okay, now capital structure theories. There are basically three theories. One is relevant theory, another one is irrelevant theory, and others are other theory. Like these are theories which are like non-classifiable under theories. So first of all, relevant theory. Relevant theory covers two aspects. One is net operating income approach, another one is Modigliani-Miller's 1958 approach. Why is it specifically given is Modigliani-Miller actually had an approach where he ignored practical aspects like taxation, risk and all. Okay, later when he realized that in a real market condition, if we are not going to consider taxation and other risk factors, our theory is not going to be applicable uniformly, or it's not going to be very much practical, which is usable actually. Because the main purpose of constructing a theory, what is the main purpose of constructing a theory? In order to apply it to something and get return out of it, right? I should be able to apply a theory and gain benefit out of it. Only then it is valuable. So what about a theory which is not practically applicable? It's just a theoretical one. I'm not going to be benefited from it. Okay, even though if I'm going to calculate Modigliani-Miller 1958 approach, I'm not going to get any benefit out of it, because in real world there is obviously existence of tax, right? So it cannot be applied. So that's the reason why he corrected himself, and they started another one with tax in 1961. So you'll have to change it at 1961. Okay. Now let us see what is relevant theory. Relevant theory says that the change in capital structure will definitely affect the capital structure decision, because whatever the structure it is existing in the company, it makes sense to understand how much cost is incurred in each of the capital, and based on that we can change the alternate or upcoming capital decisions. Okay, So if let us say if KE is increasing day by day, we'll have to see what should be done, and we'll have to appropriately restructure the capital. So all these things are possible only when we consider the capital structure to be relevant. If I say whatever be the ratio of debt and equity, the value of firm will always be same, it will not at all change, risk will be always constant, everything will be constant, tax will not be there. So what is the practicality lying in this, right? So in relevant theory, we basically say that the capital structure is very much forming part of capital structure decision. Okay, it is relevant to maintain the proportionate amount to be feasible. Now what is irrelevant theory says? It's like total opposite of this. Irrelevant theory says that whatever be the capital structure, it's not going to affect the capital structure decision. So let it be let equity and debt be equal ratio, and let the company have only equity. It's not going to affect the capital structure decision is what the irrelevance theory says. So I have interchanged the last term, so kindly consider that. Then, so what are the types under this? Net income, traditional, and the latest version of MM. Okay. Next, other theories. What are the other theories? Trade-off theory and pecking theory. So this we'll see in detail. So in order to understand the theories of capital structure, we need to take the following assumptions. What are the assumptions? First one, only two types of debt are available in the market. One is equity and another one is debt. Okay. Then, if dividend payout ratio is 100%, there is only two sources of fund, equity and debt, and the dividend payout ratio is 100%. Next, total asset of a firm given are constant. So whatever asset that has been given, it remains constant throughout the time. Okay. The degree of leverage can be changed by selling out purchased shares and selling shares to retain the debt. So these are interchangeably used in order to maintain the same asset value. Okay. So when we sell the existing shares, it increases their leverage. Why? Because we're going to invest more on debt. And when we sell out debt in order to buy shares, it increases. Okay. So the more the debt is, the more we get levered. So that's how it works. Next, firm's total financing remains constant. Okay. Then the business risk is constant over the time. So business risk does not change, which is like very much not practical. We consider only financial risk here, not the other factors. Okay. Then the firm has perpetual life. It keeps on going forever. That's the assumption. Probably the only positive assumption. Then consider all other factors. What are the other factors? Whatever be it, operating losses or trend, whatever be it, let everything else be constant. Okay. So it should be perpetual. The company is assumed to be perpetual. Every factor, all other factors are constant. Risk is constant. And then the financial firm's total financing remains constant. Payout ratio is 100, and taxes are not applicable, so it's tax free. So it is so that it becomes universally applicable. That's what the theory developing person thought, but which later turned out to be not practical. So they had to alter it. Fine. So these were the assumptions. Now let's go to the formula. Net income approach. The first one is net income approach. So in this, additionally, there are two more assumptions. First one, the cost of debt and cost of equity remains constant, and the KE is more than KD always. That is, cost of equity is always more than the cost of debt. Okay. Irrespective of the capital structure, KD and KE will remain constant. Fine. Then, what is the net income here? Net income could be EBIT. So for EBIT, we will be reducing interest, and for shareholders, the remaining amount would be the net income, that is earnings after tax. So since we are considering only there are two types of fund, one is equity share capital and debt, profit after tax will directly be considered as profit available to equity shareholders. Why is it so? Because we consider there is no preference shares here, there is only equity. So we're going to directly take it into consideration. Okay. Conclusion. The net income approach suggests a firm should have minimum possible debt in its capital structure for minimizing the overall cost. So whatever be your company's proposition, minimum there must be debt in it so that we can minimize the overall cost of capital. The more we have debt, we have safer because the cost incurred is becoming lesser. Okay. Higher the debt, lower the unlevered value, higher the value of firm. Okay. So this is how it works. You need not essentially go through that flow chart. Now, how is net operating income calculated? EBT, that is profit before tax. Since we consider no tax in irrelevance theory and relevance theory also, you're going to see both the computation together. So if there is no tax and if there is tax, what is the net operating income that we're going to get? Initially, profit before tax, we're going to reduce the tax portion, we'll get profit after tax, then we'll be reducing preference dividend which is not applicable. The net income would be earnings available to equity shareholders. Now when it comes to tax portion, we'll be reducing the tax and we'll get the profit after tax. From that again we'll be reducing preference dividend which is not available, and the remaining amount would be earnings available to equity shareholders. Okay. So simply put, profit after tax will be equal to earnings available to equity shareholders. There won't be profit after tax minus preference dividend, uske baad net income. Okay. Then traditional approach. As per traditional approach, as a result of financial leverage, amount of debt up to some point is optimal. Okay. Now overall cost of capital comes down and thus value of the firm increases. So according to this, as a result of financial leverage, that is as a result of inclusion of debt in the capital structure, up to some point it remains optimal. What remains? Cost of capital remains optimal. Then after some point it comes down and thus the value of the firm will increase. If the cost of capital comes down, the value of the firm increases. However, the financial leverage increases beyond the optimal point. If the financial leverage is going to increase beyond the optimal point, then the equity shareholder will start expecting more returns, because the return on investment shows to be higher, right? Whenever we see there's an increase in the scope of getting income, we want the fund to be invested. We want it to generate more income so that it can meet the fixed expenses like paying interest to the debt and all. So all the risk factor will be covered with the help of increasing return. So that's how it works. Then existing debt holder will also demand more return, leading to increase in KO. So by this way it keeps adjusting, just like demand and supply, it fluctuates and adjusts itself. Conclusion. In traditional approach, increased leverage, that is the more we include on debt, only up to optimal point where KO will become minimum and value of the firm will be maximum. So under traditional approach, we increase the debt value only up to an optimum level. We won't increase it beyond it. If we are going to increase beyond it, we are going to have adverse effect. So if we are going to have till that, then the minimum, the overall cost of capital will be minimum and the value of the firm will be maximum, which is favorable, right? Additional assumptions of traditional approach. KE is more than KD. So KD remains constant for a certain period and then it starts increasing. Then KE remains constant for some period, but after that when the leverage increases, the financial risk increases, thus KE will also increase. Okay. Then cost of firm, that is overall cost of firm, initially decreases, then according to the capital structure it changes. Okay, so this is the traditional approach now. Next comes net operating income approach. What is net operating income approach? Here we'll be considering the same net operating income, that is profit available to equity shareholders, but here KE will be more than KD and KD will always remain constant irrespective of the amount of debt. Whatever be the ratio of amount, the proportion of debt that is being invested, the KD will always remain constant. Okay, as the financial leverage amount of debt increases, KE will increase to compensate the increase in financial risk. That is, the more I invest in debt instrument, the more is the need for the company to give interest to me, right? So if I going to raise more amount in loan, then I will have to pay more interest to it, which is a risk factor, because interest is a fixed expense, and whether I earn profit or not, I will have to pay it, right? So on that note, my risk is increasing. As my risk is increasing, the expectations of shareholders will increase that I should get more return to set off the debt, so that we can get better leverage. Okay, so we can have better profits. So that's why in net operating income approach, we say that if the debt is more, it will increase the risk. When the risk increases, the investor will expect the return to also increase, and eventually this will increase the value. Okay, so that's how this works. So the increase in debt capital structure leads to increase in KE, such that KO remains constant. Okay, so KE will increase. So that's the reason why in this approach they say whatever be the combination of debt and equity, the value of firm remains constant. Why are they saying it? Let me give you an example. Let us say the value of equity is 5 lakhs and the value of debt is 4 lakh. Now the total value of firm is 9 lakh, right? Now even if they are going to change the proportion, let us say value of equity is 3 lakh and debt is 6 lakh. Here the proportion has changed, but the value remains constant. Why is it so? This is because the more we take loan, the risk of paying fixed income increases. When the risk increases, as an investor, I expect the return also to increase, so that I can meet the risk, right? So that's the reason why they keep constantly auto adjusting factors and bring out the KO to be constant. Even though the proportion of equity and debt is changing, the overall cost of capital remains unchanged, or it remains constant. Okay, then here's the simplified version. So if debt increases, weighted average cost will decrease. If financial risk increase, then cost of equity will increase, then that will result to increase in weighted average cost of capital. Okay, so the new weighted average cost would be existing, and the changes would sum up to new weighted average cost of capital. Then comes Modigliani-Miller approach. So Modigliani-Miller has given two approaches. One is without tax, and another one is with tax. Without tax is formulated in 1958 and with tax in 1963. So when it comes to without tax, it falls under irrelevance theory, where he says that all these factors such as composition of capital structure is irrelevant. Whatever be the capital structure, value of firm remains constant. That's the irrelevance theory's quotation. Now when it comes to tax, it says relevant. So tax is relevant, okay, risk is relevant. The more the risk, the proportion of composition of the capital structure is different, the value of firm will also change. So that's the value of firm, overall cost of firm will also change. Now approach provides behavioral justification. So what is the reason for 1963 is, in 1958 also we had the same conclusion that if the risk increases, it will increase that is, if we are going to increase the application of money in debt, or we are going to raise more fund from debt, this will it will not affect any kind of impact, or it will not have any impact on the capital structure. So the value of the firm remains same whether there is an increase in debt or decrease in debt. That's what they say. So when the debt is going to increase, my risk will increase, and will have to increase the return from equity. This is what practically is applicable, right? So this justification was given only in 1963 theory. So in 1963 theory, they were able to give a behavioral justification as to why increase in debt is resulting in increase in cost of equity, and therefore resulting in constant value of firm. Why is it happening? The behavioral justification was given in this approach. So the capital markets are perfect and all information are freely available is the first assumption. Secondly, all investors are rational. Firm can be grouped into equivalent risk classes because we can classify the firms into risk classes, that is they'll have the same proportion of interest of debt. So all these things will be matched and they'll be classified into equivalent risk classification. Then corporate taxes does not exist, which is completely a fantasy. Then corporate leverage and personal leverage are substitutable, and a company and individual can get debt at same rate and interest. So in practical world there are differentiations, but according to this approach, individual as well as company both can get debt in the same rate as that of each other. Okay, so note, the proposition of approach applies to only homogeneous risk classes, that is only those people who are having the same type of risk classification or going through the same level of risk will be able to apply approach without tax in their calculations. Okay. So in this, how do we calculate NOI? So as usual, EBIT minus interest would give us the debt. Sorry, would give us the earnings after tax, right? Earnings before tax. From that we'll be reducing the tax and we'll getting the earnings after tax. Since here there is no taxation required, the tax would be 0. So if we follow the same format also, we'll get the same thing. The only thing we'll have to remember is tax will be always 0 here. Okay. So what is the behavioral justification given here? Value of unlevered firm will be equal to value of levered firm. Why is it so? Because value of unlevered firm will not have any debt at all. It will only deal in equity. Okay. On that note, it will have better return. Now when it comes to levered firm, they'll have debt also, equity also. Now since they have debt, they'll have to pay fixed charges. So this increases the risk. So risk is increasing, equity shareholders will expect the return also to increase. So that's how it works. Okay. So you can make a note of this. So what are the propositions of non-tax? So without tax, what are the propositions made by the approach? First one, value of the firm. Value of the firm would be, as usual, income divided by respective cost. So value of firm, what is the overall cost of capital, right? So net operating income divided by overall cost of capital. Why am I taking net operating income instead of taking net income? Because in net operating income, it includes both interest part as well as the dividend part, right? So this can be applicable to both the capital structures, debt as well as equity. That's why I am taking overall firm. For overall firm, I am taking net operating income. When it comes to cost of equity, then it will be earnings available to equity shareholder divided by cost of equity. Now what about the company which has only equity, which has no debt? Then on that note, the EBIT will be equivalent to earnings available to equity shareholders, right? So where in case of unlevered firm where there is no debt, EBIT can be considered as earnings available to equity shareholders. On rest of the case, earnings available to equity shareholder will have to be calculated. Okay. So net operating income will be taken for whole of the firm, and for individual composition accordingly it will be calculated. So always the value of levered firm is equal to unlevered firm because it earns more return. Fine. So KE of levered company is more than KE of unlevered company because the firm has debt and it expects to have more return. Then KE of levered firm is equal to KO of unlevered firm, that is KO minus KD into D by S, that is debt by shares. So that gives the proportion in which it is to be divided. So this is the formula for it. Then capital structure does not affect the KO or value of firm. Why? That's what it was discussed, because we assume that there is only one factor, that is risk, that is going to determine everything. But this justification was not given in no tax thing. Only in tax approach or tax theory the justification is provided. Okay, that's the reason why they created another theory in 1963. Okay, so this is the derivation of formula. If there is someone who is very much keen to know how the formula is derived or want to understand it fully, can refer to this derivation. This is how the formula is derived. Now comes arbitrage. So before going to arbitrage, let us discuss the illustrations. Okay, let us see the basic illustration questions. So up to illustration number 8 we can cover. So we'll try to cover it first. So you need not worry, I have covered all the possible theories in this thing. So straight away we can go to illustrations. Illustration number 1. Rupa Limited's EBIT is 5 lakh. The company has 10%, 20 lakh debentures, and the equity capitalization KE is 16%. We are required to calculate the market value of equity and firm. We know that value of firm is equal to debt plus equity, right? So how will we calculate shares? Value of shares will be income available to shareholders, that is net income, divided by K. Okay, that is 16%. When it comes to debt, we have 20 lakh rupees. So 20 lakh into 10% would be 2 lakh. So 2 lakh would be the interest income. So 2 lakh divided by, what is the percentage? 10%. Okay. So EBIT minus interest, we get the net income. So from this net income, we are going to divide it. We are going to divide the KD. We are going to get the cost of debt. Okay. So overall capital will be summation of both of them. 1 minute. So as I said, earnings available divided by KE. We got the value of equity. So from the value of firm, if we reduce the value of equity, we will get the value of debt. That is as simple. Okay. So simply we can remember that value of firm is equal to value of shares plus value of debentures. Since KD is not given in the question, we have only KE in the question. What we can do is, from net income we can divide the KE and we can get the value of shares. We know that value of firm is equal to value of shares plus value of debt. We know the value of firm and value of shares. So from this, if we're going to subtract, we're going to get the value of debt. So that's how it is being derived. Okay. So overall cost of capital would be EBIT divided by value of firm. Okay. Traditional approach. Illustration 2. Indra Limited has EBIT of 1 lakh. So value of firm can be calculated with this. The company makes use of both debt and equity. So the company has debt as well as equity. Okay. The firm has 10% debenture of 5 lakh and the firm's equity capitalization rate is 15%. So first I'll have to calculate net income, right? How will I calculate net income? My EBIT is 1 lakh rupees. From this I'll have to reduce the interest part, that is 15%, what is 10%, which is 50,000. So remaining would be 50,000. Since we know there is no taxation, this would be directly net income available to equity shareholders. Now from this, if I am going to divide it with 15%, I am going to get my cost of equity, value of shares. So we know the value of firm. How do we know that? We have EBIT. With this, if we are going to divide the overall cost of capital, we will get the value of firm, and from that we can get the debt. Okay. So basically, we are calculating the earnings available to equity shareholder divided by KE. We are getting value of equity. We know that value of firm, overall capital, is equal to EBIT divided by KE in case of only levered firm. Okay, so unlevered firm, right? So we also know that value of firm is equal to shares plus debenture. So we are going to apply this to calculate the entire cost of capital. Okay, so now overall cost of capital would be KE into value of share by value of firm plus KD into value of debt divided by value of firm. So with this, we are going to find the overall cost of capital. Illustration number 3. So determine the optimum capital structure. So what is the meaning of optimum? It should be kept like it is the basis. It is the minimum number of minimum proportion that is to be maintained. So determine the optimal capital structure of a company from the following data. What is given? Options. Okay, this is the KD and this is the KE. So this plus this will give you value of firm, right? So the percentage of debt on total is given. So this means what? If there is 0% debt, then it is 100% equity, right? So 100 into 13% would be 13. Then it is 0.1% debt. Then that means that 90% is equity. So accordingly 0.90 into 13. Then 0.2% is debt, then 0.8 is equity. 0.8 into 14 will give you cost of equity, weighted average. So we'll have to calculate like this for individual units, and we'll get the summary as this. So in this, what is the lowest overall cost of capital? This one. 12.8 is the least of all the 7 possibilities, right? So we will be choosing this. Net operating income approach. Illustration number 4. Amita Limited operates EBIT which is 5 lakh. Now the firm's overall cost of debt is 10%. So KD is equal to 10%. We have EBIT, so we can easily calculate value of debt, that is 5 lakh divided by cost of debt. Then currently the firm employs 15 lakh of debt. Okay. Now interest we'll have to calculate 15 lakh into 10%, right? Then overall cost of debt is 15%. Overall cost of capital is 15%. So KO is equal to 15%. With this also we can find KE. So let us see how we are going to find. First statement showing value of firm. We know the EBIT, that is 5 lakh. From this we are going to reduce the 10% of 15 lakh, that is interest part. We'll get the earnings available to equity shareholders. If we are going to divide this with the cost of equity, we will get the value of firm. Okay. Then cost of equity. How are we going to calculate the cost of equity? We know that value of firm is equal to S plus D. So we have got V now. So from that, if we are going to reduce D, we will get S. So that's what we are going to do, because D is obvious, and we know that EBIT divided by KO will give us value of firm. So value of firm minus debt that is taken will give us the value of shares. Or alternatively, we can use the formula also. More time saving could be this one. Okay, we can directly apply this and get the answer. But it is also advisable to solve question with this formula, because there are certain questions where only this formula can be applied, right? So it's always better to solve it in both the ways. Anyway, answer is going to be the same. Illustration number 5. Alpha Limited and Beta Limited are identical except for capital structure. So they have everything same except the capital structure. So what is the differentiation here? Alpha Limited is having 50% debt at 8% interest, and Beta Limited is having 50% equity, 80% equity, 20% debt. Okay. So Alpha is having 50-50 ratio, Beta is having 20-80 ratio for debt and equity. But the rate of interest seems to be the same. Now everything else is same, risk classification is same, everything is same. So EBIT can also be considered to be same, right? So let us see. If you own 2% of shares in Alpha, determine your return if the net operating income is 3,60,000. Okay, so Alpha has 50% debt, right? So total value is okay 8%. Fine. Now let us start solving. So EBIT is 3,60,000, right? We'll just take this. We know that out of total fund, 50% is equity, 50% is debt. So 50% will be considering as equity. That is 10 lakh will be equity, 10 lakh will be debt. So 10 lakh into 8% will give us the interest. So when we net it off, we get the earnings available to equity shareholders. And in this, we have only 2%, right? So we're going to take just 2% into consideration. That is 5,600. Then When we talk about beta limited, it is 20:80 ratio, right? 2:8. So we'll divide the total 20 lakh into 2:8, that is 4 lakh and 16 lakh. And from this, we'll calculate the net operating income. So net operating income is 3 lakh 60. From that, we're going to reduce the 8% interest on 4 lakh, that is 32,000. We'll get the earnings available to equity shareholders. Now this amount is to be divided by KE to get the value of shares, right? Now, how do we calculate the implied rate of return? Implied rate of return can be calculated by overall earnings available to equity shareholder divided by market value of equity. Okay. So, if we observe, the overall implied rate has changed for alpha versus beta. Why is it? Because of the change in proportion of risk. Because alpha limited has 50:50. That is equal proportion of debt and equity, whereas beta limited has 20:80, where he pays less interest and he divides more profit. Okay, so this is arbitrage related question. So let us get back to concepts again. Arbitrage. Okay, so let's do one thing. Let's have arbitrage in a separate part. I want you to solve the remaining questions till then. So try to complete the remaining possible questions either from practical or redo the illustrations again and get yourself thorough with the formulas till illustration number 5. So we'll meet in the next video where I'll be explaining you the arbitrage procedure and what are the steps to solve the arbitrage questions and what are the different ways or possibilities of arbitrage questions that are available and how we're going to solve it. I'm going to dissect each and every procedure or type into steps and make it simpler for you to present it in the exam. So exam presentation will be covered in that. Thank you.